Chapter 12, Cash Books, Bank Statements, Bank Reconciliations and Petty Cash. So the key points in this chapter, there's only one cash book which has a receipt side, money into the bank, and a payment side, which is money out to the bank. The receipt side is on the left side of the cash book, and that's called the debit side, where the journal is debit bank and then credit the analysis accounts, analysis columns, referred to in the columns. Then there's a payment side that's on the right hand side of the cash book, and that's called the credit side. But again, the journal is credit bank and then debit the accounts referred to in the analysis columns. A single column cash book only deals with movements in the bank account, so it's really always referred to as the cash book. It's not actual physical cash really, it's the actual bank account really. And so it's going to include payments from debtors on sales made on credit, and also payments from customers on cash sales, or on the debit side, let's say. Now, in a double column cash book, that's going to deal with movements in the bank account and physical receipts and payments of cash. So a cash account really. So we have two tier accounts within a double column cash book. In practice, this approach is rare beyond a sole trader, but you're going to see it as an exam because it's a really good test of neatness of double entry bookkeeping. The cash book can be a book of prime entry that's used to make entries into the bank account in the general ledger, or a cash book could be a book of prime entries to collate the accounts and also form the account in the general ledger. And then what we have with this one is we're going to have to then put brought forward and carry forward balances in there. Now, actually, it's more likely, in fact, it is what's used, is that the cash book is the book of prime entry and the ledger. And the reason for that is because the need to use a bank reconciliation, which is part of the principles and controls unit. But we're going to go through it here to explain why it is that actually we always have the cash book as the book of prime entry and also forming the T account within the general ledger. Now, the only reason why you're going to see a debit side, because quite often you will only see in the exam the debit side of the cash book or the credit side of the cash book. Now, that's not because there's two separate cash books in there. The only reason why you see that in an AAT exam is because you can't fit the whole debit side and credit side of the cash book on the page. Actually, it's the only reason why you see it in the books as well, because the way in which sort of fonts and book size is done. Now, in this book, because this is the videos for my introduction to bookkeeping book, I deliberately go for a much bigger sort of A4 size, because then you can actually see the cash book side by side, with the debit side and the credit side in there, and that's the reason for size in there. It doesn't work in the ones which use the smaller types of books, and can be really confusing really. You don't have two separate cash books with this thing, the debit sitting on one side and credit on the other. One cash book, that's it. Journals which will affect the trade receivables and trade payable control account in the general ledger. So when we're going, let's say credit trade receivables, could be debit bank credit trade receivables, or debit trade payables. When we're going credit bank debit trade payables. That's going to be posted also to the purchase and sales ledgers as well, to the various respective customer accounts within the sales and purchase ledgers. So, business prepares income and expenses for posting to the general ledger through the cash book. So this is where we're using the cash book as a book of prime entry only. So in here, our business prepares its income and expenses for posting to the general ledger through the cash book. That can be prepared from payment runs created and amounts that are set out in bank accounts. Banks actually often enable company customers to download their bank statements electronically that can be entered into the cash book or electronic systems. And then it can be uploaded into an accountancy system. That's also an advantage of digital accounting systems, which you'll need for that particular part of the unit. We'll see that in a later chapter. The columns can be set out in the cash book any way that speeds up the posting of journals to the accounts in the general ledger. So you're not going to have a consistent layout here. So here I've got wages, supply payments, energy, and then this sort of general discussion kind of one here. Whether energy is important for this company, but might not be for another. So the analysis columns, these sort of ones here, these analysis columns here, are going to be however the company decides to set them out. There's not a standard layout for that really. What we'll have in our cash book then is we've got a debit side here. This debit side here, which represents the debit posting to the cash. Now, when I say cash, it's a bank account really. Now we'll see what actual physical cash there is. So it's called cash. Now the reason why it's called cash is because of the way in which it's called in the financial statements. That it's cash and cash equivalents in the financial statements, which actually represents the bank account. In terms of a cash book, then it's got two sides: a debit side here and a credit side. Now that doesn't mean that doesn't mean that it's posted as a single journal, you know, just sort of debit bank and credit bank. There's debit bank here in our general ledger, and then credit, the analysis columns here. So credit here, we got trade receivables, and then we got these particular ones here, because you can't have loads of them. You can't have every single general ledger account here. So there's some detail here. So credit shareholder capital, credit interest received, credit sales, and credit VAT. On this side here, we've gone credit the bank account, debit VAT, debit wages. And here, debit this van purchase over here, let's say, debit this photocopying here, debit the energy account, and debit our trade payables. Yeah, so that's what you got in terms of how our cash book is. You know, they are two-sided journals because they go into the general ledger. Yeah. Now, it is possible, in fact, it's more likely that you're going to see a cash book in an exam that includes this sort of brought forward amounts in here. So in this figure here, what we're going to now do is we're going to use the cash book as a book of prime entry and also the ledger. This is the more likely thing, and this is how it's also done in practice as well. If we're using a manual system, they're not really used anymore, but if we were. So we got here. What we're actually doing is we're bringing the cash brought forward figure into here. And the bank account brought forward figure into here. We've got our cash book going on in here. Debit all of our bank account, credit all of our bank account here, and then we're going to carry forward position and bring it forward for the next year. So this is the next period. So this is a T account here, our T account for the cash book, for our bank account. T account for the bank account, and then this replaces the ledger in the general ledger. So we don't, in the general ledger in this instance, we don't have a separate T account in the general ledger for our bank statement. In the previous cash book, we did, because we haven't got the brought forward and the carry forward balances now. Now, I sort of said that this approach is the more likely approach in here, producing the T account and not having an account within the book that is the general ledger. This is still the account in the general ledger, and the figure that's going to go into the trial balance, but it's separate. It's its own separate book. The reason why, which we'll see later on in this chapter, is because of the need to perform bank reconciliations, and part of the bank reconciliations is that you have to sort of tick off all these items to the bank account, to the bank statement. So you have a bank statement and you go through and you tick all these various items on there to see what's missing from the bank's bank statement. And similarly, you have to sort of tick the bank statement to see what's in the cash book and then from what's missing. So because of the need to produce bank reconciliations and the need to tick in here, we can't just post into a general ledger control account debit the cash book or debit bank, and we can't debit the total of the columns. We actually have to put all the individual amounts in there anyway. So we'd be putting all of these individual amounts into our general ledger account. We can't put those totals in there because we then wouldn't be able to produce a bank reconciliation. And a bank reconciliation is probably one of the most important tasks, if not the most important task in the finance department. So because of that, we're always going to use the cash book as the book of prime entry and also as the ledger as well. Now, if you're going to do that, then what you've got to do basically is you just need to understand T accounts. So if you're not fully sharp on T accounts, or you should be, having done the first few chapters of this book, you'll need to go back and get that right, because otherwise this is going to form a very big question within the exam. Really, it's very unlikely that you're not going to see a cash book question as the book of prime entry and as the ledger, and also as our petty cash one as well. So very much tests of double entry bookkeeping. You'll need to be very sharp on that point there, and dead click isn't going to help you. Right, so we've now got something which is called the two-column cash book in here. Now, it is possible you might see this in exam, which has got two T accounts in here. So we've got a T account for the bank account, and we've got a T account for cash. So we've got physical cash here, and we've got bank account. So we'll have physical cash sales that might happen on site in here, which will be going through the cash amount, and then we might have some sort of customer receipts going through the bank account. So things going through the bank account, let's say these ones here, and so in this book then we've got two of our ledger accounts, and we've got two cash books going on at the same time, one for physical cash and one for bank. Was this really used ever in practice? Well, in practice, really, for a company, no, because it would be too much of a mess. You know, there's two accounts very close together. There'd be a heck of a lot going on within a company set of accounts. In fact, there's a lot going on in this whole traders anyway. The chances of error are really, really high. so you wouldn't use it really in real life in a company. Also, as well, there's a practical thing there, that probably there's the cash book for the physical cash. You probably hold on by the till. Or it's on the front reception desk for for admin or what have you, admin staff doing it, and the bank account one is in the finance department. So they're actually sort of separate, two different people producing it. So in practice, not really used in there, except perhaps for sole traders. So if you were, let's say, I don't know, a publican, and you took some money for your drinks in cash, and you also took things in terms of card machines in there, you might complete this sort of 2-column cash book for your business. You probably would have left out the brought forward balances and the carried forward balances, because you wouldn't be an expert in accountancy. And then you hand it over to your bookkeeper, who just did it all in Excel anyway. So perhaps it isn't really sort of helpful there either. But you will see it in the exam. You'll see it quite a lot in the exam, and the reason is that because it's a very good test of neatness and double entry bookkeeping. Can you be neat and put the right figures in the right columns, so you can spot that this is cash sales here and put that into the cash column? Can you see that these are payments into the bank account, put them into the bank account in here, and do that kind of thing going on? Be very neat about the way in which you're doing it in here. So if that can be achieved, so here we've got some we go out and we buy some, we purchase some photocopying down the road with some cash, and we take out the petty cash tin or what have you. Can you be neat, and can you understand the concept of T accounts really in here, that you've got these two sets of T accounts? A really good way to test double entry bookkeeping, that sort of neatness, and also as well that T accounts is understood by the money in, money out method, rather than say dead clicking. Then that's why it's sort of going to sit there. Relevance in an accountancy system today, not at all. Especially with Excel as well, you just put it as two different Excel accounts, even if you were producing it in effective manual accounts. But very, very good in test of the exam. That's why you see a lot of it in the exam question. Now, I sort of highlighted for the book of the cash book as the book of prime entry, and also as the general ledger account, the need for a bank reconciliation. Now, a bank reconciliation is done under the principles of bookkeeping controls unit. It's the hardest unit within this level, really, in here, because it requires keeping to technique, and also as well in terms of good strong double entry bookkeeping as well. So hardest unit in there, and we normally would stay away from it, but stay away from it at this level. But we've got this need for bank reconciliations, and I said that was really important and was driving how the cash book would happen. So what is a bank reconciliation? And really it's a check between the cash book, and does that line up, is it consistent with what we're seeing in the bank statement? Now, they're not going to agree. The cash book figure is going to be different to the amount that's in the bank statement, and that's because of timing of payments. That we might have had some checks, or we might have sort of paid somebody into the bank that hasn't cleared yet, and as a consequence there's a timing difference where something's in the cash book and not in the bank statement. But there's also things that are on the bank statement that are not in the cash book, so things like interest received or bank charges. There could be cash book errors. We might have posted something in the cash book that's £54, let's say a £54 receipt, but actually it was £45 that went through the card machine. And of course, there's the possibility of whether people are actually paying checks on or bounce checks is another possibility. So you've got this difference, but of course, cash is incredibly important for the business. It has to be right, and also it's the place of highest risk for fraud as well. So we've got to be right, and we've got to reconcile it. So this is a really important task that's always done in the finance world. We reconcile our cash book to what's in the bank statement. Now, the way in which we do it in real life, the 4-step method to bank reconciliations, is we reconcile the brought forward balances for the previous period. So that sort of says, right, well, what was the things that were missing in the bank statement in the previous period, and we tick those off in the cash book. Then we tick everything that's in the bank statement that's in the cash book. So we tick it off in the bank statement, and we tick it off in the cash book. So we have anything that sort of makes sure that we've got all these things ticked off. Then anything that's we update the cash book for any items that are missing that are on the bank statement, these sort of bank interests or bank charges, and then we reconcile the bank statement to the revised cash book. And we reconcile it here, bank statement figure. We sort of take off our unpresented checks from the bank statement figure. We add on the outstanding lodgements. This is the cash book figure. Is it the right figure? And it reconciles. Now, in an exam, we do it the other way around, and the reason why is because they don't give you the previous bank reconciliation, the previous bank month's reconciliation, so it's slightly quicker in an exam to do it. Ticking everything in the bank statement first, the cash book, and then reconcile the balances. Well, why is it then that this is important? Well, in terms of, if we go back, and let's slide all the way back to here. If we've got to do all this ticking. Now, if this was in a separate book, if we're posting just these total figures to the general ledger, well, what are you going to tick? You haven't got anything to tick really, so you can't do that. Then you'd have to go back into the cash book and see exactly all the various things. You'd be going to different pages of the cash book, where it'd be a total mess. So what you'll have to use the cash book as the book of prime entry and as the ledger, because you've got to do all this ticking in the bank reconciliation. So that's the reason why it's done and will be done in real life. Nobody runs with a separate bank account. Well, you can't. Now in an electronic system, obviously there is no books of prime entry. It's just going directly in. So this would be the account this would be the print off of the account in the digital system, and then you just do the ticking again, really. So that's how that works. But it's a good example actually how in digital systems as well, books of prime entry don't really exist, and they're just T account reports. So we have now done our. I'm now going to go petty cash. So really, what we're sort of saying is we keep referring to cash as really the bank account. But what about physical cash that's been held in sort of small amounts? We've done something called a petty cash. Now, so this was for small sales and expenses. So let's say somebody comes along and they buy a couple of pens from our front reception, or more typically, can we just post this package and put it through the franking machine, this thing that sort of puts the postage on, and so they pay over some small amount. But more importantly, it's for expenses, whereby we don't really want to have all the cost of somebody going and putting an expense claim form for like a £2 jar of coffee that they've got for the weekly team meetings or what have you, and we just take sort of £2 out of this sort of petty cash tin. But it's cash, and so it takes on a life of itself. It's far more important because of the possibility for theft. And theft undermines the running of our business. So even though it might be £5 being stolen, it undermines the whole credit culture of our organisation, and therefore it has to be it takes on a life of itself and is far more important than the cost that's been happening. So what happens then in this situation? Well, the finance department doesn't like cash not being held in the finance department, so it gets upset about that. So it only provides a loan. So it provides a loan to, let's say, the front reception, and this loan's undertaken under the imprest system. Now, why is it called the imprest system? Well, it's because of the Latin called impresto, which is for a loan. That's the only reason why it's called that there, though. It's basically, it's basically the petty cash system. It's an imprest system because we always get back to this sort of loan amount that the finance department sort of handed over, that it's prepared to accept in terms of the amount that we want to have, because we don't want to be faffed around with all of these expenses. So here's the amount, you're going to bring it back up to that £100 or whatever. But similarly, if they've suddenly got 500 quid because they've not banked anything, and we're not really happy about that amount being held in there, so we're always going to get back to this sort of amount that we agree, this sort of, let's say, £100, £150, whatever. So it's frequently reconciled, and we top it up, or we pay back into the bank account. So let's have a look at the petty cash book. So here we've got a debit side and analysis columns again, and then the amount in here. And then we've got our credit side as well. Our debit side here, we sort of starting now. I've sort of brought this figure back up to £100 here, but you'll probably start with a total figure up there, and then that'll tell you what the imprest figure is in an exam. You've got your receipts in here with the analysis columns that are going to be posted to the general ledger, and then we've got this amount here in terms of our cash. Now this one is going to go to the general ledger. We're not going to do a bank reconciliation to a bank statement. We won't have one. What we'll do is we'll reconcile, we'll go along to the petty cash tin, and we'll see whether that £100 exists. No. Now, how do things petty cash happen? Now, you will have an exam. You might be able to be looking to produce a petty cash voucher from amounts there. So you might be able to produce a petty cash voucher, or alternatively, you might get these petty cash vouchers and sort of put them into the petty cash book in here. And so we got various sort of things in that petty cash voucher. So You've got this example here, it's sort of set out here and there. The company can set out petty cash vouchers however it wants to. This might include cost codes. In real life, they don't tend to get filled in, so you're going to have sort of cross checks with like the department or whatever. We're certainly going to see the sort of name of who's going to request this petty cash in here, and then we've also got the manager who's going to authorize. Now you see here, I'm sort of giving this an idea of I acknowledge I'm sort of in line with company financial procedure, whatever. And this is because this is a high possibility for fraud, or for fraud in terms of people putting in dodgy claims, or managers just not reading them. Right, so that's where we are in terms of you might want to sort of have to complete those. So that's the end of this chapter. Let's now move on to chapter 13.